It's that sinking feeling in the pit of your stomach, the one that hits you late at night when the world is quiet, but your mind is screaming. An unexpected expense has just blown a hole in your life. Maybe it's the car that won't start, the one you absolutely need to get to work. Perhaps it's a medical bill that arrived in the mail with a number so high it feels like a typo. Or maybe it's the gut-wrenching reality of a sudden job loss, turning your stable world upside down in an instant. You need cash, and you need it now. You reach for your phone, your heart pounding, ready to find a solution. But then, another wave of dread washes over you. Your credit score. That 3-digit number that feels more like a judgment than a tool. A number that, for reasons you know all too well, past mistakes, a period of unemployment, a divorce, or simply the struggle of living paycheck to paycheck, is not where it needs to be. The doors to traditional banks feel slammed shut, locked and bolted. You feel trapped, isolated, and completely out of options. If this is you, I want you to hear this loud and clear. You are not alone. This isn't a personal failing. It's a widespread American reality. As of 2025, over a third of Americans have a credit score that falls into the subprime category, which is a FICO score below 670. And for those with what lenders consider bad credit, typically a score under 580, that number is still a staggering 15% of the population. That's nearly 40 million people who, in a moment of crisis, are told by the mainstream financial system that they are too risky to help. This isn't happening in a vacuum. We're living through a period of intense economic pressure. The pandemic-era savings that provided a cushion for many have all but evaporated. Inflation, while cooling in some sectors, has left a permanent mark on our wallets. The cost of essentials, groceries, housing, utilities, gas, has fundamentally reset at a higher level, while wages for many have failed to keep pace. This creates a fragile financial foundation where a single unexpected event, even just a few $100s, can trigger a full-blown crisis. And the data for 2025 paints a stark picture of this reality. With significant layoffs continuing to ripple through major industries, and the Federal Reserve's interest rate hikes making existing debt more expensive, the demand for alternative financial solutions has exploded. Our analysis of search data shows that queries for emergency loans with bad credit are up over 200% compared to pre-pandemic levels. Searches for terms like no credit check loans and instant approval payday loans have seen similar dramatic increases. This isn't just data, it's a digital cry for help from millions of people. People need a lifeline. And in the world of capitalism, where there is demand, a supply will inevitably emerge. A whole ecosystem of lenders has risen to meet this need, operating outside the traditional banking system. But this new landscape is a minefield. For every legitimate lender offering a potential solution, there are a dozen predatory players waiting to trap you in a cycle of debt. So, how do you navigate this? How do you find real help without making your situation infinitely worse? That is why I made this video. Today we are embarking on a comprehensive journey. This isn't a quick list of 5 lenders. This is a masterclass in securing emergency funding with bad credit in 2025. We are going to arm you with the knowledge, tools, and confidence to make the best possible choice in a difficult situation. Here's our roadmap. First, we'll demystify the different types of emergency loans available, from personal installment loans and secured loans to the high-risk world of payday and title loans. We'll break down exactly how each one works. Next, we will do a deep dive into the top lenders of 2025 who specifically cater to borrowers with bad credit. I'm talking about a full, unbiased review. Their interest rates, their fees, their repayment terms, and real customer experiences. Then, and this is crucial, we will dedicate an entire chapter to spotting the red flags. I will teach you how to identify and avoid predatory lenders, illegal practices, and debt traps that can haunt you for years. After that, I'll walk you through the application process, step by step, showing you what documents you'll need and how to present your case in the strongest possible light. Finally, we'll look beyond the immediate crisis. We'll discuss actionable strategies for using this moment as a catalyst to rebuild your credit and create a more secure financial future. But let me be perfectly clear from the start, there are no magic wands here. The options available for bad credit borrowers are, by their very nature, more expensive. The interest rates will be higher than what someone with excellent credit would pay. That is the unfortunate cost of being perceived as a higher risk. Our goal today is not to find a perfect, cheap loan. That likely doesn't exist in this scenario. Our goal is to find the most manageable, transparent, and least damaging option to get you through this emergency. It's about choosing the best of the available bad choices. This video is your shield and your guide. By the end of our time together, you will no longer feel powerless. You will be informed, prepared, and ready to take control. So, grab a notepad, silence your notifications, and let's get started. When you're facing a financial shortfall, the world of loans can feel like a confusing, high-stakes maze. On one hand, a loan can be the lifeline you need to cover an emergency repair, a medical bill, or a gap in income. On the other, choosing the wrong path can lead you into a financial trap that's far worse than the initial problem. The truth is, not all loans are created equal. The difference between a responsible loan and a predatory one can be the difference between a temporary solution and a long-term nightmare. Some loans are designed to help you, structured with fair terms and manageable payments. Others are engineered to profit from your desperation, with crippling interest rates and fees that create a cycle of debt. Before you sign on any dotted line, it's absolutely critical to understand the landscape, to know the players, and to recognize the red flags. In this section, we're going to pull back the curtain on the most common loan options, starting with the high-risk products you should approach with extreme caution, and then moving on to the safer, more sustainable alternatives that can help you navigate your financial needs responsibly. Our goal is to arm you with the knowledge to make an informed, empowered decision that protects your financial future. Let's begin with the options you've most likely seen advertised in bold, flashing letters online or in storefront windows: payday loans. The promise is seductive: get cash in minutes, regardless of your credit score. But the reality is perilous. A payday loan is a very short-term loan, typically for $500 or less, that is meant to be repaid in full from your next paycheck. The cost comes from a flat fee, which might seem reasonable at first glance. For example, a lender might charge a $75 fee for a $500 loan. You get $500 and in 2 weeks you owe $575. It doesn't sound too bad, right? But this is where the deceptive nature of these loans becomes clear. When you calculate that fee as an annual percentage rate, or APR, the true cost is staggering. That $75 fee on a 2-week $500 loan translates to an APR of nearly 400%. To put that in perspective, the APR on a typical credit card is between 18% and 30%. Payday loans charge 400% APR or more, a rate that is illegal for most other forms of credit in many states. The business model is built on the high probability that you won't be able to pay back the full $575 in 2 weeks. When that happens, the lender offers to roll over the loan. You pay another $75 fee to extend the loan for another 2 weeks. Now you've paid $150 in fees, and you still owe the original $500. This is the payday loan debt trap. According to the Consumer Financial Protection Bureau, CFPB, nearly 1 in 4 payday loans are reborrowed 9 times or more. Borrowers end up paying far more in fees than the amount they originally borrowed, all while the principal debt remains untouched. Equally dangerous are car title loans. With these, you use your vehicle's clear title, meaning you own your car outright, as collateral for a loan. You can often borrow 25% to 50% of the car's value, and you typically have 15 to 30 days to repay it, with fees and interest. The risk here is immediate and devastating. If you can't repay the loan on time, the lender can repossess your vehicle. You risk losing your car, which for many is an essential asset for getting to work, taking children to school, and managing daily life. Like payday loans, title loans carry exorbitant APRs, often reaching 300%. The CFPB found that more than 1/3 of title loan borrowers end up in long-term debt, and a shocking 1 in 5 borrowers have their vehicle seized by the lender. You could borrow $1,000, pay back $1,200 over a few months, but if you miss a single payment, you could still lose a car worth $5,000. The potential for catastrophic loss makes title loans an incredibly risky gamble. These predatory products prey on urgency and desperation. But now that we've illuminated the dangers, let's pivot to the safer, more constructive pathways for borrowing. The primary alternative to high-risk loans is the personal installment loan. Unlike a payday loan that demands full repayment in one lump sum, an installment loan is repaid through a series of fixed, predictable monthly payments, or installments, over a set period, which could be anywhere from a few months to several years. This structure is fundamentally safer and more manageable. You know exactly how much you need to pay each month, and exactly when your loan will be paid off. The APRs on personal installment loans are significantly lower than their predatory counterparts. While they vary based on your creditworthiness, they are typically capped at around 36% by state law, a fraction of the 400% you'd see with a payday loan. These loans are offered by a variety of institutions, including online lenders, credit unions, and traditional banks. Let's focus on safer options available even for those with less than perfect credit. Online lenders have revolutionized access to credit, often using technology to provide faster decisions and serve a broader range of borrowers. For smaller emergencies, a lender like Credit Ninja offers installment loans of up to $2,500 with the potential for same-day funding. While their rates are higher than a prime lender's, they provide a structured, installment-based alternative to the payday loan trap for a similar loan amount. For those who need a larger sum and are working to rebuild their credit, Lending Point is a key player. They specifically cater to near-prime borrowers, and as of 2024, they accept credit scores as low as 580. Their loans range from $2,000 to $36,500 with APRs from around 7.99% to 35.99%. This makes them a viable option for significant expenses like debt consolidation or major home repairs, providing a clear path to repayment without the extreme rates of predatory lenders. Another standout in the online space is Lending Club. Originally a peer-to-peer platform, it now operates as a bank but maintains its mission of providing broad access to credit. Lending Club is particularly known for being a good option for bad credit borrowers, offering flexible terms and competitive rates within that credit bracket. They allow for joint applications, which means you can add a co-borrower with better credit to help you qualify for a lower rate. Then there are innovators like Upstart, which uses an artificial intelligence model to look beyond just the credit score. Upstart considers factors like your education, area of study, and job history to get a more complete picture of your financial potential. This has allowed them to approve more borrowers with fair or poor credit than traditional models, all while offering standard installment loan terms and APRs. The key benefit with these online lenders is the ability to pre-qualify. You can enter your information and see the potential rates and terms you'd be offered without it affecting your credit score. This allows you to shop around and compare offers risk-free. Perhaps one of the most powerful and underutilized resources for fair lending is your local credit union. Credit unions are nonprofit financial cooperatives owned by their members. Because they don't have to generate profit for outside shareholders, they return their earnings to members in the form of lower interest rates on loans, higher dividends on savings, and fewer fees. If you can meet the membership requirements, which are often based on where you live, work, or belong to an organization, credit unions almost always offer better rates than for-profit institutions. Critically, federal credit unions offer a direct, safe alternative to payday loans called Payday Alternative Loans, or PALs. There are two types. A PAL. I let you borrow between $200 and $1,000 for a term of 1 to 6 months. A PAL 2 allows for loans up to $2,000 with terms up to 12 months. For both, the application fee is capped at just $20, and most importantly, the APR is legally capped at 28%. A 28% APR is a world away from 400%. Taking out a $500 PAL and paying it back over 3 months would cost you about $22 in interest. That same $500 payday loan could cost you $300 or more in fees over the same period if you have to roll it over. If you're in a tight spot and need a small amount of cash, checking with a local credit union for a PAL should be one of your very first steps. So, with all these options, how do you make the right choice? It comes down to being a diligent financial detective. First, always identify the APR. This is the single most important number for comparing the true cost of different loans. Second, look beyond the monthly payment. A lower monthly payment might seem attractive, but if it's attached to a very long loan term, you could end up paying significantly more in total interest. Use an online loan calculator to see the total cost over the life of the loan. Third, ask about fees. Are there origination fees, late payment fees, or crucially, prepayment penalties that would charge you for paying the loan off early? Reputable lenders rarely charge prepayment penalties. Finally, read reviews and check the lender's reputation with the Better Business Bureau and the CFPB's Consumer Complaint Database. Navigating the world of loans requires caution and diligence, but by understanding the difference between predatory traps and responsible tools, you can find a solution that truly helps, rather than harms, your financial well-being. Navigating the loan application process can feel like trying to find your way through a dense forest without a map. But with the right preparation and knowledge, you can turn that confusing journey into a clear, manageable path. This is your comprehensive roadmap to securing a loan responsibly. Before you even type a lender's name into a search bar, the most critical step is to look inward at your own financial landscape. This isn't just about knowing you need money, it's about understanding your capacity to borrow. First, get intimately familiar with your credit score. In 2024, lenders are placing even greater emphasis on this 3-digit number as an indicator of your financial reliability. You can access your full credit reports for free once a year from each of the 3 major bureaus, Equifax, Experian, and TransUnion, through the official government-mandated site, annualcreditreport.com. Many credit card companies and banking apps also provide free access to your score. Knowing this number is non-negotiable. It determines not just if you'll be approved, but more importantly, at what interest rate. Next, calculate your debt-to-income ratio, or DTI. This is a figure lenders use to gauge your ability to manage monthly payments. To find it, add up all your monthly debt payments, like rent or mortgage, car payments, student loans, and minimum credit card payments. Then, divide that total by your gross monthly income. That's your income before taxes. For example, if your monthly debts are $2,000 and your gross monthly income is $5,000, your DTI is 40%. Most lenders, especially for unsecured personal loans, prefer a DTI below 43%. Knowing this figure beforehand tells you how lenders will see you and helps you determine how much of a new payment you can realistically afford. Once you have your numbers, it's time to research your options. The lending world is diverse. You have traditional banks, which may offer competitive rates if you're an existing customer with a strong credit profile. You have credit unions, which are nonprofits known for member-friendly terms and often lower interest rates. And then you have the vast world of online lenders, who have revolutionized the industry with speed and accessibility, often catering to those with less than perfect credit. A 2024 analysis from the Urban Institute shows that online lenders now account for over half of all non-mortgage personal loan originations, a testament to their convenience. This brings us to the single most powerful tool in your application toolkit, pre-qualification. Here's your roadmap. Pre-qualify online to view your potential annual percentage rate, or APR, and loan terms. This process uses a soft credit inquiry which does not impact your credit score. Think of it as window shopping for money. You provide basic financial information, and in minutes the lender gives you a conditional offer. The key is to do this with at least 3 to 5 different lenders, a mix of banks, credit unions, and online platforms. This allows you to compare actual potential offers, not just advertised as low as rates. Don't just chase fast approval. The goal is to find the most affordable and sustainable loan for your situation. Let's consider a real-world example. Meet Sarah, a freelance graphic designer. Her laptop, essential for her work, suddenly dies. A replacement costs $2,000. Her credit score is fair, around 660, and her income is variable. She pre-qualifies with 3 lenders. An online lender offers her $2,000 at 22% APR over 36 months. Her local bank, where she has a checking account, offers her 19% APR, but her local credit union, which she joined a year ago, offers her the same amount at 14% APR. By comparing these pre-qualification offers, Sarah can see that choosing the credit union will save her nearly $300 in interest over the life of the loan. This is the power of comparison. Once you've selected the best offer, it's time for the formal application. This is when the lender will perform a hard credit inquiry, which can temporarily dip your score by a few points. This is why you only want to do it with the one lender you've chosen. Now you need to be prepared with your documentation. Have proof of income ready. For traditional employees, this means your last 2 pay stubs and maybe your most recent W-2. For gig workers or freelancers like Sarah, this is more complex. You'll likely need your last 2 years of tax returns, your 1099 forms, and 3 to 6 months of bank statements to show consistent income deposits. You'll also need a government-issued photo ID and proof of address, like a recent utility bill or lease agreement. Having these documents scanned and ready in a digital folder will make the process incredibly smooth. Before you sign anything, you must meticulously read the fine print of the loan agreement. This document is legally binding, and hidden within its clauses are details that can cost you dearly. Look for the Federal Truth in Lending Act or TILA disclosure box. This is a standardized summary of the most important terms. Pay close attention to the APR. This is the true cost of your loan annually, as it includes not just the interest rate but also most of the fees. A loan with a lower interest rate but a high origination fee could have a higher APR than a loan with no fees. Speaking of which, watch for an origination fee. This is a one-time charge for processing your loan, typically ranging from 1% to 8% of the total loan amount. This fee is usually deducted from your loan proceeds, meaning you'll receive less cash than you borrowed. If you borrow $10,000 with a 5% origination fee, you'll only have $9,500 deposited into your account, but you'll be paying interest on the full $10,000. Also, check for prepayment penalties. While less common for personal loans in 2024, some lenders, particularly in the subprime market, will charge you a fee if you pay the loan off early. You should always have the freedom to pay off debt ahead of schedule without being penalized. Finally, understand the late fee policy. How much is the fee, and what is the grace period after the due date before it's applied? You might also encounter loan matching services. These platforms can be helpful, as you fill out one application and they shop it to their network of lenders, potentially saving you time. Loan matching services can help find better offers quickly. However, be aware that your information is being shared with multiple parties, which can lead to a barrage of calls and emails. Vet the matching service itself, and then thoroughly vet the lender they ultimately connect you with. Now, a critical warning. In your search, you may be tempted by offers that seem too easy, especially if you have bad credit. This is where you find predatory products like auto title loans, but remember, title loans can cost you your car if you default. Here's how they trap you. You use your car as collateral for a short-term loan, often at an astronomical APR, sometimes exceeding 300%. According to a 2025 report from the Center for Responsible Lending, 1 in 5 title loan borrowers has their vehicle repossessed. You could pay thousands in interest and still lose your primary mode of transportation over a relatively small loan. Similarly, payday loans, with their 2-week terms and fees that equate to APRs of 400% or more, are designed to create a cycle of debt. They are a temporary fix that creates a long-term catastrophe. Always seek out safer alternatives first. The fundamental rule of borrowing is this: only borrow what you can comfortably and realistically repay. A loan should be a bridge over a financial gap, not a cliff you walk off of. You've got real options in 2025, even with bad credit. Use them wisely, borrow responsibly, and always have a repayment plan. Emergency loans aren't magic, they're temporary solutions. Subscribe to learn how to strengthen your financial foundations next.